Good afternoon from Investment Confidential. Well, I wanted to do this midday to let the market settle, see what the thoughts are. It's always good to see how the market is moving up or down, even though usually the market's wrong, believe it or not. The Fed. Look, I think the focus here has to be on statements he made and more importantly the Q&A. So if you didn't watch the Q&A, one of the key questions he was asked about recession and also about his target. And he made no bones. I got to give him one thing. I'm not a fan of Powell. I think he's the worst possible person we could have running the Fed right now. But he did say that he's sticking to his 2% target. I think he had to say that. I think the markets were anticipating something more dovish. He is a dove, by the way. I'll go into that in a few minutes. But he was very adamant about his 2% target. The realization is, anybody who knows anything about inflation will tell you that currently in the U.S., having a 2% target is a joke. There's no possible way. The only possible way a 2% target is if he pounds the economy into a depression, a deep recession depression, which is a possibility, but we're ways away from that, right? So a 2% target in the time frame that the markets are looking at, right? Markets look ahead 4 to 6 months, maybe shorter now than ever before, is a pipe dream. It's not going to happen. Inflation is at 8%. It has peaked, like I mentioned before, and inflation is coming off, but it's not going to come off to 2%. It's ridiculous. Inflation probably will go down to around 5%, 4% before it stabilizes. But remember, folks, we have printed almost $1.5 trillion. Okay, for those of you who are deep into Bitcoin, you know what that means. Okay, it is a disaster. We have debased the currency, and the only reason our currency is not weak is because the rest of the world has debased their currencies, and we've got this war and other kind of potential situations. So the dollar is strong and it's bailing out the government. We've got high inflation. We've got a strong dollar. Guess what? It's exactly what the White House and the government wants, because one of the ways to reduce debt, and by the way, that's the reason they want that, is because our debt is out of control, right? We're almost 100%, over 100% of GDP. The only way to get rid of that is to inflate it away. That's what they're doing. So now they've got Powell here on one hand, who's a puppet, and he is trying to, be a tough guy, right? So he's saying 2% target, 2% target. Well, if he gets a 2% target, the country will be headed for a depression for sure. Like I said, I don't think it's going to happen. I think he's going to raise rates till we see inflation come down to this 4 or 5% range. Then he's going to sort of stabilize and stop the cutting and say, well, just like he did with the transitory statement. It's not transitory, but he said it was transitory. Then he walked back his comments. He's going to walk back this 2% target for sure, and it's going to be more of a 4 to 5% target. And he's going to say, hey, let's stick with this 4 to 5%. Inflation's sticky, and we're going to stick to 4 to 5% range. This is not good, right? 4 to 5% inflation is not good for the U.S. economy, for more importantly for the U.S. individuals. But that's what's going to happen. The other questions regarding the recession, he danced around it, but recession is we're already in a recession. It's not going to dissipate anytime soon. When we see the GDP numbers, they will confirm that we are in a recession, and if not the third quarter, but the fourth quarter for sure. That's it. We're going to suffer this, and we continue to say that the biggest risk is the dollar. Rates are going higher. He is going to bring up rates till he pounds the economy into a recession. He's going to overshoot as normal because he's way behind the curve, and the U.S. dollar will continue to go higher. Powell, in a sense, is almost guaranteeing a recession here and almost guaranteeing that the U.S. dollar will continue to go higher. One of the things the talking heads are talking about, and obviously the White House keeps talking about, is this idea of full employment, right? We're at 3.5% employment. This is great unemployment. This is why we're not in a recession, et cetera, et cetera. Well, this is fantasy land, okay? layoffs, if you all you have to do is watch the headlines. Meta, okay, Zuckerberg says he's going to lay off people. Ford is laying off people. Goldman Sachs, J.P. Morgan, they're all, the finance industry is laying off people. I mean, you go and look at headlines out of California, San Francisco, all the big tech companies, they are laying off people. Okay, so this fantasy that we're in this full employment is just complete hogwash. We're going to see the unemployment rate rise. We're going to see these numbers start to deteriorate very quickly. All right, and it's happening already, but obviously the talking heads don't want to talk about it, but it's happening. The job numbers that we're seeing, they're pretty much fake. When you talk about the economy is in trouble, and okay, if that's what Powell's looking for, he's going to get it. He's going to get a troubling jobs number, and again, he's a dove. He's going to use that to slow down this rate increases. And by the way, he should be doing QT, and he said he was going to do QT before he even raised rates. He's done nothing. And in the Q&A, he was asked about mortgages, right? Because again, this whole idea of this real estate market being, the mortgage rates and all of this. Well, the government hasn't even started QT yet with mortgages. They purchased more mortgages than they did bonds. They need to reduce the balance sheet, and they're not doing it. Okay, that's really, really dangerous. He's playing a dangerous game, thinking he can knock the rates down. He can get the rates up and then knock it down before we have this problem with mortgages. I mean, this is a disaster. Okay, so he's going to be forced to do QT. And when that happens, we're going to see, again, another leg down, probably in mid-2023. The real estate market will take it more on the chin. I'll talk about more about it later. I want to mention one thing that I mentioned a few days ago, this TINA. There is no alternative in terms of the stock market. Forget that. That's dead for, next generation they'll be talking about that. This 2-year bond spike. Okay, right now, if you look at money market rates, if you're looking to park some money, remember they told you never to go into cash. Now is a good time. Money market rates are at 2%. So they're going to be well over 2% by the end of the year. In some cases, they'll be significantly higher, maybe 3%. If you don't care about the next 2 years, in terms of putting your money at risk, you can right now buy 2-year paper at 4%. Okay, government paper at 4%. That's going to outperform stocks, believe it or not, I believe, over a 2-year period. You're going to have ups and downs. If you're a good trader, it doesn't make sense for you. But if you're an investor, flocking your money in, guaranteed, no risk at 4%, right now is not too bad. It's going to be higher in a few months. So if you want to wait for 4.5%, 5%, go right ahead. Dividend stocks are going to be interesting. Not right now. I think at the end of the year, there'll be some good entry points, but I'd be watching any kind of dividend paying stocks going forward because they're going to take a hit, or they have been taking hits. And again, it could be an interesting, this whole volatility is creating an interesting entry point. Remember, Powell is a dove. Okay, this is what I'm saying. Powell's a dove. He's in the pocket of private equity. The first chance he gets to stop raising rates, he's going to do it. It's not going to help the economy. It's not going to help earnings. It's not going to help the stock market more than a couple days, but he'll do it. Inflation will come down, but as I said, inflation is going to be sticky. There's no chance of this 2% target, but he will, at the first sign of trouble, the first sign that he thinks that he's accomplished his goal, which he never will, but he thinks that he is going to stop this raise in rates, and then you're going to see an economy in deep recession, essentially in stagflation. I don't know what he does at that point. It's just hard to fathom somebody like this, what he's thinking. In the short term, the very short term, we are definitely headed for some kind of cyclical rally. Oversold conditions are all over. You look at the put call ratio, RSI, or more importantly, cash levels at large fund managers. Which is high. These are all pointing to some type of counter-cyclical rally like we had in July. The other anecdotal evidence that nobody talks about, but I think for you guys out there, you gals out there, you certainly will understand this. Social media stock mentions, okay, in this chart, they're plummeting, right? So what has driven this movement of stocks over the last few years? It's been millennials, it's been Gen Z, it's been younger investors, the Robinhood generation, buying stocks, not buying funds, not buying products, buying stocks. And obviously all your information is coming from social media, which it should, because CNBC is a waste of time for anyone to listen to or watch. But social media mentions are plummeting. That shows that, okay, again, counter-cyclical. We're in oversold conditions. People are getting a little nervous. They're not engaged in the market like they used to. Things have come down. That's something to think that we have something interesting ahead. But again, it's only short term. I keep mentioning real estate. I'm going to mention it again. All the evidence shows that we've had some really major damage happening in real estate. It's actually happening faster than I expected. As I mentioned before, with real estate, prices go up very fast because people are, very fast to put up prices to capture a rising market. But human nature tells you that people are very slow to bring down prices. But it looks like we're seeing the opposite happen across the country. Again, if you're living in New York, San Francisco, Los Angeles, or Miami, or Florida in general, you're not seeing this, but you will. You're just delayed. You will see it. Within 6 months, you're going to see prices in these markets also drop. But the rest of the country, whether it's Austin, Texas, whether it's in North Carolina, whether it's in Phoenix, etc., prices are coming down, and they're coming down fast. Inventory is rising. We saw some evidence of that yesterday, but it's rising in these multifamily, etc. And we're also seeing houses being built, what couldn't be built because of shortages in lumber. That's no longer the case. So they're building houses because they have the financing in place. And if they don't build the houses, they lose the financing. So they are building houses, most likely for no buyers. Again, real estate continue to tumble. And if you're a patient buyer, you will benefit dramatically. So to sum it up, the Fed did what they said they were going to do, 75 bips. Powell talked tough, talked the markets down, which he should. But again, he's a dove. Don't listen to what he says. He's going to change his mind, going to change gears as soon as you see the inflation come down a little bit. I'm talking 8% today. Maybe it comes down to 7, and at 6, he'll start think he won, starting raising the flag, said he wins. He'll begin to slow down this movement higher in rates. But he's never going to reach that 2% target while he's in the Fed, unless he puts the economy basically in depression. Well, once again, happy trading and vaya con Dios.